This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, he is the judge, the jury, the executioner. He is all three things. He's Robb Reinhold.
Wow, that is a lot. And it made me feel more powerful when you said that. But hopefully it doesn't go to my head, and I think this is a dictatorship. Good to be here. Let's talk about position sizing today.
Yeah, so this was really interesting when you brought it up. I'm like, is this even a problem? Because in order to talk about something, it has to be a problem first, or else, why fix it? But you, with an actual sample size, because you have so many people working under you, and I don't, you were like, yeah, no, this is absolutely a problem, even with professional prop traders. Now, our audience ranges from people who haven't even traded yet, all the way up to people who've put 20, 25 years in the game. So it's interesting to see that you were saying, and correct me if I'm wrong, that even people at the prop firm level and people who have been in the prop firm ecosystem for years still risk too much in terms of position size. Am I correct to say that?
Yes, you are correct to say that. And I really wanted this episode to be basically the red flags, the things you're going to tell yourself to deviate. And look, if you still want to deviate position sizing, you still want to wing it, you're still in the phase where you haven't truly become a professional, hardened trader yet. You just haven't. You haven't gotten there. Position size is non-negotiable. It's just period non-negotiable. It is, you just have to do it every single time. If you still are playing around with it and deviating, then you have not made it yet to the point where you can say, hey, you know what? I am on the level of a professional trader. Now look, just because you get there, things pop up and things change. And this is what this episode is going to be about. It's going to be about, okay, you understand the importance of it. You're there. What are the little things that are going to pop into your brain that's going to be like, the devil on your shoulder tapping you? Be like, hey, what about this time? This time you can bend the rules because of this. That's what I want this episode to be all about.
Okay, and for those of you who don't know what we were referring to before, if you're new to the show, this episode and every episode is sponsored by Robb's prop firm, and the prop firm I belong to as well, Maverick Trading. Yes, is on the pricier side to join, but it is one of those firms that wants to keep you there. And we'll talk a little bit later in the show about firms that maybe don't want to keep you there. So choosing the right prop firm and putting forth the money up front, assuming it's right for you, it's not right for everybody, but it is right for a lot of you, is a very important decision. So take a look at all the links down below from Maverick Currencies. They have a stock and options division, and then they have a Forex and currencies division as well. So moving on, let's talk about, we'll start off with, I think, what would typically not happen to a professional prop trader. This one is going to happen to somebody who's really starting out for the first time because they're so excited to jump right into the pool that they've seen all these charts when they were learning. They saw these tools that seem to work really well. They've actually maybe put them onto a demo account chart, and they're chomping at the bit to make all of this money in Forex, for example. And they're so excited that they have absolutely no structure when it comes to position sizing. You would think this would be a requirement to start trading, but oftentimes you're saying, and if I think about it, I probably agree with you, this is a skill that actually comes later, right?
Sadly, the answer to that is yes. Today, things are much better today as far as the amount of education that's out there, the amount of, things that are out there to walk you through getting started in trading. And position size has become part of those basics of, hey, you need to learn this basic part of trading because it is required to trade correctly. I got into trading in 1997. There was no books on position sizing. There were no hints or there were no sayings of, hey, just do this. It just didn't exist. So when I started trading and I had my account, how much to put into each trade was completely arbitrary. And sometimes I did a big one, sometimes I did a small one, sometimes I did a little. And again, there was no consistency in this. And so what happened was I had uneven results, meaning that the positions that I put a lot of capital in that worked for me made me look really good. But if I had a loss on a position that I had a big position size in, it actually would wipe out 3 of the winners. So imagine I go ahead and put, a little bit of capital on 3 winners, and then I start to feel confident, so I put a big chunk on the 4th trade in that loses. I have a 75% win ratio, but I've lost money in my account. Position sizing is so important because remember, when you actually enter a trade, you have no control of what's going to happen. You think every single one of those trades is going to work out when you make them, or you would never have made them. But in the end, you're going to get your win-loss percentage, you're going to get your profit factor. You have no idea to know which ones are the good ones and which ones are the bad ones. So you have to treat them all the exact same.
Yeah, I was laughing a little bit when you first said, back in 1997, there really was no such thing as position sizing. I mean, there was, but you're right. There was no reference out there. Like, I'm sure there are people out there who wanted some type of structure to follow, but if there's nothing available, then there's nothing available, which is a crime against humanity, because there is no way you are going to have any type of long-term sustained success without some sort of risk structure and just position sizing in general. And so I got news for you. Flash forward to 2024, there still isn't a lot out there with all of the resources we had. So for those of you who might not know, on No Nonsense Forex, if you still don't have anything to go by, go to my risk video. And when I put that out and actually showed people not only how to position size, but how to adjust it to the volatility of the currency pair you were trading, I got such tremendous feedback from people that said, I've been looking for something like this my entire trading career, and it never existed until now. And I'm sitting there like, really? How is this even possible? What were they teaching you if they weren't teaching you this? This is literally a prerequisite for anybody to become successful at this long term. I was just so blown away by a video that I thought was compulsory almost for anybody, but it turned out to be revolutionary. I couldn't believe it.
Position sizing is the most important part of trading. And I hope you can hear the gravity in my voice, because it is everything. I am in charge of when people go through Maverick and they do their demo trading, they do their trading plan, and they turn in all of their statements and their trading plan to say, hey, you know what, I'm ready to go, check out what I've done. I am the one that goes through those trading plans and those trading statements. The very, very first thing I do, because these trading plans can be sometimes 15, 20 pages long, the very first thing I do is I go find their position sizing and risk management. And if that fails, I don't read another line. I reject it and send it back to them and say, go fix this first. I'll look at the rest later. That's how important it is to us at Maverick. As I said, if I read that and I don't like it, I don't care what indicators you use. I don't care about anything. It's getting rejected, sent back until you fix that position size.
Yeah, and I'm sure you probably got some pushback on that too. Like, well, when I demo traded, it worked really well. It's just a matter of time, Rob. You gotta give me some time for this system to work. Did you ever get any blowback from this, or is it pretty obvious to people? Okay, maybe I should have some type of structure.
I can't remember if I got any blowback, but this is something I think everyone who's savvy enough, who's been around long enough, knows how important it is. It's like when you were very first as a trader. Imagine your very first time you ever sat down to read anything about trading and someone talked about risk management. It didn't really ring a bell to you. Risk management seemed like some dumb job that someone had in an office somewhere. Once you get into the markets and trade enough times, you know that risk management is really, really important. And so I think, by the time people get to a certain level where they're building systems, it's not really that hard of a conversation to have, especially when you can point out some of the issues that are going to happen. And when you point out those issues and they say, yeah, you know what, that happened to me 2 years ago. And what happened? Well, I halved my account. Exactly. So it's not that hard of a conversation with traders who have been in the game for a little bit.
Well, that's good to know. Yeah, because risk management, like you said, it's pretty much everything. I even tell people, I manage risk for a living, which I do. In trading and investing, in business, everything, really. That's kind of what every adult pretty much does to some degree. I think we just tend to do it more because we really don't have a choice but to have it absolutely, to not have everything just completely optimized when it comes to your risk management. Because you know how this industry is. There's just hardly any room for error, especially errors that you are repeating over and over again. That's going to sink you right away. But let's go ahead and keep moving forward here, Rob, if we can. We're really talking about the reasons why somebody might end up making the wrong position size, whether it's going to be too much, too small. I think the most common one is probably too much. So ignorance is certainly one of them, but that's almost not your fault. That's just a matter of not knowing what to do. These next few we're about to talk about, if this is happening to you, it is absolutely your fault, and the very first thing we need to do is recognize it and address it. So Rob, go ahead and start us off with the next one.
The first reason I want to talk about that people deviate from position size is they look at their account size. They look at their account size, and if it's not very big, they're going to look at, okay, I'm going to be putting in all this work and effort into trading, and if I do it right, I'm going to get X% a month, a year, whatever it is. And then they do the math, and they see, oh, that's only $100. That's a lot of work for $100. They look at their account, they look at their trading results, and then they see that it's not going to produce much money. We at Maverick say, do not focus on money, always think in terms of percentages. Everything is percentages, because if you make the percentages, the money comes. If you don't make the percentages, it doesn't happen. A lot of people will look at their, let's say someone puts a small Forex account of $500, and they're like, hey, I'm going to make some money. Their goal is not to learn how to trade and get good trading numbers. Their goal is to make money. Well, I hate to break it to you, but there is zero chance for you to make any significant money off of $500. And if you were to really trade that account responsibly with good position sizing, you might double it every 18 months. Just think about that. Double it every 18 months. Do you know how long it's going to take you to get to a point where you have a big enough account that is actually going to matter? So what happens is people tell themselves, well, I've got to go bigger because it's not worth my time to go slow and steady because it's not going to produce the money I want. So what they do is they overposition size, they take big losses, and it's so sad because they never got to the point where it paid off. That's the saddest thing, is that they just couldn't wait for it to grow.
Yeah, and I hate to pick on this part of the world, but this is what you see a lot in places like Africa. And I mention Africa because Africa is Forex crazy. South Africa, Nigeria, Kenya, Ghana, big trading areas. And unfortunately, I think why it's so big is because of what they were likely promised. So if you are starting out with $500, that's a few months' salary in a lot of places, for example, right? And to say people live paycheck to paycheck in certain parts of the world is an understatement, right? So this can be a lot of money to somebody, but you obviously don't want to move that $500 up incrementally. You want more. Now, with leverage, Forex allows you to do this. And therein lies the problem. We've spoken about this on the show before, Rob. how most of us, no matter where you come from or how much money you have, were allured by the crazy upside potential you could be earning because of leverage in the Forex market. Remember, this is all before crypto. So what happened is that people were sold this false bill of goods and their mind just stayed there. And then when I come in, and I had an episode, a podcast episode, my very first podcast, and it was about 30, 35 episodes in, called How Much Does It Actually Take, or What You're Actually Going to Need. And I told everybody, guys, if you have under $1,000, for example, or even if you have $5,000, $10,000, you're never going to make the money you want. It's just not possible. So stop doing it, because that money you do have, no matter how much it is probably quite important to you, and you should use it for other things like savings, like investing, like whatever, because you're going to lose it, because you're going to risk too much, and at some point it's going to go away. Now, I also came with a solution later on and said, hey, this is where prop firms come into play. Prop firms are not going to give you a lot of money up front. Why would they? That's absurd. But if you show that you know what you're doing and you can grow that initial amount at a reasonable, mature rate, they will give you more. And then you just repeat the process, no matter how much they give you, and you're going to be just fine. That's really the key, because most people can't just drop 6 figures into a trading account, but you have to do this right. But man, you're so right about this, Rob. Having an account that's too small and thinking, man, why do I want to work so hard to make $20 and be proud of it? That's not worth my time. I want to make a lot more, and that's exactly why every single one of us crashes and burns when we first start out.
And if you think about it, the saddest thing is that, becoming a good trader just takes time. Look, I wish you could just be born a great trader. It's not how trading works. It takes years to become a good trader. And it's just really sad that, the need and the desire to make a lot of money off of your smaller account size is going to cause you to fail. And by fail means you never get to the point where you were a good enough trader to generate a good return, where capital then starts to matter. Because capital doesn't matter. I don't care if you start out with 100 grand or 1,000. If you don't know how to trade, it's going to zero. It's going to go to zero. So if you have the right perspective, then yes, that's how you need to look at it. You're not trying to make money. You're trying to make percentages. You're trying to prove that you can make percentages. You're proving your win-loss, your profit factor, all your trading numbers. Then it's all just a matter of capital. And the prop firm route is a route you could take, but another route you could take, and we've talked about this, Patrick, is to feed your account. Feed your account an extra $100 every single month. Save up money, cut back somewhere, feed it an extra $100 a month. That's going to really help that account grow much faster, to where you may be able to double an account, again, a small account. So let's say you start off with $500. If you just put in $100 a month and break even, that account will double in 5 months. If you're able to add on some return, it's going to double even faster. Now you're doubling an account every 3 to 4 months in the beginning. Now look, as this gets bigger, your $100 is going to help grow it less and less. But again, there's ways to make it faster, but it's not over position sizing. You have to do this the right way and be willing to use the compounding interest over decades in order to get the results that you want.
Yeah, and just know that even if you do things the way Rob just said, temper your expectations. You're still not going to get rich fast that way. You will get rich faster, but we're still talking about a pretty long time. Like, it does take money to make money no matter what you're doing. And so I have always recommended using somebody else's money, and I would strongly prefer, just for my own sanity, choosing a company's money over a stranger. So your two choices, in my opinion, not to go too far off on a tangent here, are to do it yourself with a small amount, or to actually have a real chance at real upside and go the prop firm route. And thankfully, there's a lot of them out there. We're going to kind of segue into that, maybe not right away, but into this next section, Rob, to where one of the other reasons why you might be intentionally making the wrong position size is because of what happened in your last few trades. Very interesting. Go ahead and speak to this a little bit, and I'll jump in where I can.
This is going to be the one that is probably the most important to anyone who's been trading from 1 to 5 years. So speaking to those of you in that range, this is the one that's going to be really dangerous to you, where you've done it enough, you've got it down, but now you've got this, I call it baggage, the baggage from the past trades that is going to come into your next trade. Now, typically, the way I see it the most is when people take losses. People take losses, let's say you took 3, 4, 5 losses in a row. Now, statistically, that's pretty much guaranteed to happen to everyone at least once or twice a year. That's just a guaranteed statistic. You can go one of two ways, and it's crazy because they're both wrong. I have people that get gun shy, and what they do is they cut their position size down. Now, just think about this mathematically. If you are trading, you trade 5 trades and you take a 1x loss. Okay, so each one of those trades you took your, whatever you decided your position size is going to be, loss. And then on the 6th one, you chicken out and you say, I'm only going to do a half a position size. Do you realize that you need to have 10 winners in order to even get back to where you were? All of a sudden, you've put yourself in a really bad situation mathematically, where it's now going to be even harder for you to get out of a drawdown. And guess what? You're very unlikely to make 10 winners in a row, and you're even more unlikely to have 15 winners in a row, which is what you would need in order to actually go above where you started. It's just mathematically, it's such a bad decision, but yet psychologically, we feel it. Psychologically, we're like, oh, I don't have the confidence anymore. I'm going to cut my position sizing down. On the other side, we have people that take 5 losses in a row and say, you know what? How about I make my 6th trade larger? Now, they make it larger because they say stuff to themselves like, well, statistically speaking, I should have a winner here pretty soon. Guess what? Your 6th trade has the same odds as your 1st, 2nd, 3rd, 4th, and 5th trade. It's all the same. They make it bigger so they can recover those losses. Like, okay, I got to recover my losses. If I just go a larger position size here on trade number 6, all of a sudden now I've recovered 2.5 of my losses. So they're not even looking at the trade. They're looking at the past results, and they're looking to make it too large. So those are the two ones I really see. And losses tend to mess with people more than wins. We're going to talk about a series of wins after this, but these losses, they really seem to be the one. Patrick, have you ever had anything like this in your life or heard about it from someone else?
Yeah, early on, oddly enough, I never really chased losses. Now, I don't think we need to tell you not to chase losses on this podcast, or maybe we do. But we're going to talk in just a moment about why there might be an increased chance that in normal situations you would not do this, but in certain situations you're going to be compelled to. But yeah, I was always more kind of the chicken out person, where if I was taking losses, I didn't want to take any more losses, but the trade was still there. So what do? Well, I'll just bet half, what I normally risk on this trade. And, of course, Murphy's Law, that's the one that did really, really well. And I should have put a regular position size in there because I would have made back all of my losses. But no, I deviated from my system. Position management is part of your system too. So no matter how you deviate, it all ends up, hurting you long term. But yeah, I want to transition into wins too here, Rob, because when you have dread with losses, you have euphoria with wins. And we've talked about this on the show too. But what are some reasons that after a really great string of wins, and now I think I'm the smartest trader in the world, now I think I just ate the star in Super Mario Brothers and I am invincible and I'm untouchable, what might I do how might I deviate from my position sizing now? What are the most common errors you've seen from your traders on this one?
Let me use a personal example of this, because I don't know if I've told this story before on your podcast, but the last major trading mistake I made was in 2008. And this is that story. I was, again, 2008, the economies were crashing around the world, and I was very bearish at the time, and I was trading Aussie yen. Now, I do what's called a pyramid strategy. What that is that I take a position, and then if it goes my way, I take more of a position. If it goes my way, I take more of a position. And the whole time, I'm just adjusting my stop to never have more risk in it than I did on the first trade. So theoretically, if you have a trend that keeps going, you theoretically are entering in multiple times. And again, each time there's a setup that presents itself, I'll grab more, adjust the stop. It was during September of 2008, and things were absolutely collapsing. And I had built up 44 lots of Aussie yen on the short side. And when I finally exited the position, the entire position averaged out was a 400 pip gain. That ended up being about a $180,000 gain. And it was a huge gain for me. And it was one of those days, pumping fist, like, oh my gosh, I can't believe this happened to me. And I told myself, Rob, just chill out. Like you just hit a home run. Just chill out for a while. Don't make any trades. Because I knew that this is my pattern where once I had a big win, I went even bigger the next time. Well, I didn't do it. And my next trade, I started out with 100 lots. I started with 100 lots. Now, when I clicked that button, just from the bid-ask spread alone, I was down $3,000. The second I clicked the button, my P&L said negative 3,000. And right there I said, uh-oh. And I knew it, but I'm like, nope, I'm going to let this trade go. Huge position size, ended up losing 100,000 of that. And I was so livid and upset with myself, that I knew better than that, but yet this one got me. So look, I like to tell these stories. They're not great to tell because they make me feel a little embarrassed, but I think it's really, really helpful to share those kind of stories just as a warning that this is really dangerous. My personality is all about wins. When I get hot, when I get on a streak, I used to feel invincible, and that's when I would make my mistakes. I didn't have the problem on the other side. When I took losses, it was not a big deal to me. I was able to shrug it off. When I got a series of wins, oh my gosh, I started planning out all these things I was going to buy, planning out my family's future. Look, we've talked about this. When you get the delusions of grandeur, that's when you should really be scared. So I wanted to share that personal story just with people to let people know it happens. I've been trading for, 10, 11 years at the time. Now, I'm happy to say that's the last major mistake I've made. It's been, 16 years? But I'm still worried about it.
I think you've told that story on the podcast. I have heard it. I don't know if you've told me in confidence or on the show itself. But yeah, that is a wild one. Just lots that are so far beyond my own comprehension that it's just I'm living vicariously through you because I don't think I'll ever get there in my entire career. But just the fact that you were there and you experienced it and had that kind of rush is really, really awesome. It makes for an awesome story. The result wasn't awesome, but I even said, I think when you said it, I don't know if I said this on the show or to you, but it's like in Vegas when there's a hot roller at the craps table. Some drunk will always say, "We got a hot roller over here," and Vegas will not stop you from doing that. They love the fact that you're inviting all these other people to come play at the craps table, thinking that there's this hot roller, not understanding that the probabilities are exactly the same as it was back when there was a cold roller. The probabilities are the same. It makes no difference. That whole hot hand thing is propaganda on the highest level. But I really, really want to get to this next point because it's the one I've been talking about this entire episode. The reason why some of you, especially those of you who have gone the prop firm route or you're selling a product, whatever, are compelled to put up the wrong position size, and usually in this case it's going to be too much, is because your prop firm or your goal that you set for yourself was a certain percentage and you are currently too far away from it. Now, I have some things to say about this, but Rob, I want you to go first, and then I will add my piece because I have no idea what you're about to say here.
It actually swings both ways, where we will have someone who is underneath the high watermark. So a high watermark is you get paid out of anything above your high watermark. And we close the books in our Forex division at the end of every month, so on the 30th or the 31st. Or on our options division, we close the books on monthly options expiration, the third Friday of every month. I'm always very, very cautious about those periods because I'm watching who were the people that deadline is affecting. Because look, if you're just trading and you trade for the whole year, you don't have any deadline. You're just trading. But all of a sudden, when you start to make up these arbitrary deadlines, the third Friday of the month, all of a sudden, that's meaningful to somebody. And they're looking at their account and they're saying, ooh, I need to be profitable this month because if I'm profitable this month, I get a level advancement and I'm too far away. If I make a bigger trade and get it right, it's going to push me over the edge. That happens. I shouldn't say all the time, but look, it's something that I definitely watch for. But you also get the other one. You get the other one where the person is above their high water mark, but not by a lot. And again, they're going to get a level advancement as long as they close above their high water mark. They get chicken. They get scared. They cut back position sizes or just don't trade at all. So these periods, like in a prop firm, they are meaningful. And if you took them away, you would never deviate from your position size on the third Wednesday of the month. Like, who cares? That's just a nothing. But all of a sudden, you put this arbitrary deadline in that has some sort of significance and meaning, and it's going to cause you to change your position sizing to get the desired result you want for that time period. Now look, this is in the prop firm area and it's definitely a big thing. You know, you've got your end of the month metrics you got to meet. You've got all these things you have to meet and it's going to cause issues. That being said, it happens in regular traders' lives too that aren't with a prop firm because they're going to set arbitrary numbers for themselves.
Yeah, and if I can jump in and say two things. One, if you're not trading with a prop firm and you do set these levels, don't do it. I've said before, I like to try and beat Warren Buffett's 20% every year, but if I don't, I don't. As long as I'm consistent with my system, then some years it's just not going to happen. You know, sometimes the volume's there, sometimes it's not. There's nothing you can really do about that. You can't force things to happen because as soon as you start doing that, it's all going to go downhill. You and I were talking a bit before the show, Rob, how there's some people that have these arbitrary goals every month. And this is ridiculous on so many levels. Because especially month by month, you know, some years just aren't going to give it to you to where you're going to hit, you know, you're going to have the success you hoped for. But some months are just trash, and it's not going to give anybody, especially if you're a trend trader, anything. And so if you're still trying to eke out 2 or 3% when the market is giving you nothing, well, then this is an absolute recipe for disaster. Now, I do want to say one thing on the prop firm side, and I've said this before, there are prop firms out there that, and this is how you know a prop firm is predatory and they're really not interested in your long-term success. If they require you to make a certain percentage every month or even every quarter, I would go as far to say, or else you're kicked out, that is a very scammy, predatory business model to where they're just trying, at the end of the day, they just want your upfront fees. And they know at some point you're going to conk out, but that's fine. It's just lather, rinse, repeat. You know, so it's. I've never been a fan of things like that. Now with Robb's high watermark, that's a totally different ball of wax. That's not a requirement to stay in, but that is a requirement to advance. Totally different thing. I get that. But if you are a part of anything that mandates that you hit a certain level every month or even every quarter, or else you're not with them anymore, do not join from the start. You know, I just had to get that last part in, Rob, before I take it back over to you.
No, I will give the exact same advice for sure. One other thing I do want to talk about is it's a pet peeve of mine. So look, I'm just going to air my grievances. This is a pet peeve of mine. But I told you, like, when I get a trading plan in, if position size isn't there, I reject it and send it back. The other thing, if I see it in a trading plan, I don't reject it, but I always have this conversation because I'll see things like, my goal is to make 3% per month. I hate that so badly. I hate it. It drives me crazy, and I cannot let it go because I always have to have the discussion of, okay, look, you can't use those words. You can use words like, I want to average 3% a month over the year, because look, there's going to be some months where you get a 0. There's going to be some months that are negative 3%. So that means you have to have some months that are 6% and 9%. Like, that's how trading works. It works like a chart. You go up and down, and by saying things like 3% every month, you are absolutely putting all of this psychological pressure in your brain that is worthless. It's completely worthless to you. So I always hate when I hear people say, I want to make 3% a month in trading. I want to make whatever in trading. That's not how it works. You have to use different languages because it will absolutely set you up for doing all the stuff we're talking about here, about changing your position size so you can meet those arbitrary goals that you set for yourself that really are stupid.
I would go as far as to say, don't even say that I want to average over time 3% a month, because that's 36% a year. And if 36% a year is your goal in Forex trading, you are going to have a bad time. But let's go ahead and take care of this last one, Rob, because this has been a dedicated episode on our show. But I think it affects so many people that I have absolutely no problem hitting the repeat button on this one because it needs to be repeated. Plus, you know, I never know how many people who are listening to us right now have listened to every single episode, have only listened to a few, how many cherry pick, or how many are joining us for the first time. So let us bring this one up again. And I would even say, Rob, 20 episodes from now, we need to bring it up even again, because desperation is going to kill any trader. Maybe not at first. You know, God forbid you get lucky on the first one. You're really setting yourself up for demise later. But if you have external factors that are requiring that you have X amount of money, and you are not able to get that through your normal means, do not try to get this in the Forex market. The chances of you succeeding here are so low. And again, even if you do succeed, long term, you're setting yourself up for even more grief.
It reminds me of my favorite saying in poker. All in works every single time, but once. If you do this, and as you said, Patrick, you might get the first one. You might get the second one. You'll lose. This is the most guaranteed way to lose your account, is to treat this account as, I need to get money out of it within this time period, and I need this much money, or else something bad happens to me. That is the absolute most stressful, worst situation you could put yourself into. And I don't think any human being has a capability of rationally thinking in that point. So just avoid it. Absolutely avoid that thinking. And again, this episode is about giving you those red flags. So when these thoughts pop into your brain, that you've got Patrick on your left shoulder, you got me on your right shoulder, and we're kicking the devil off, and we're saying, no, don't screw this up. Do this the right way, figure something else out. Don't look to your trading account to make your rent. That's just really bad. So I just want to put these things into your brain so that if and when you think them, you understand that they are red flags and to avoid that behavior.
And the very last one you put on here, Rob, was a very interesting one, because this is not something I've ever really thought about. But it's having bills to pay or having rent to pay is a very short-term stress. If you, for some reason, are older, or you're getting older, and you are concerned that just due to inflation or due to the fact that you just don't have enough saved, that you may not have enough money to retire. I heard on a podcast this morning that a lot of people on the podcast were in their late 40s, early 50s, and they said, by the time Social Security comes around in the U.S., I expect to maybe get 70 cents on the dollar if I'm lucky, if it's even there in the first place. So there's a lot of stresses there because the boomer generation mostly got to retire. But I don't think generations after that are going to be nearly as fortunate. And that's a very scary thing in a lot of ways. And so what do you have to say to the people that might be pushing the envelope a little bit here because they're really concerned that they're not going to be able to quit the job that they hate and they're tired of but are sticking with because they're older and they're just simply not good at anything else?
This is a very difficult question and a discussion to have because this is a math question. This is simply math. And when you do the math, when you sit down and you say, okay, I'm 48 years old right now, I have this much money, I need to have this much money by the time I'm 65, that's just a math problem. And it's pretty clear that the math isn't in your favor. And so when you look at, okay, well, how do I change this? There's a couple different ways to change it. You can save up more, but sometimes that isn't possible. Sometimes that's very difficult to do. Or the other one is, hey, I get a higher rate of return. If I can simply raise my rate of return, then the math works out. So they really focus on raising that rate of return, and the way they do that is by taking larger risks, more concentrated risks on more volatile investments. And look, it might work out, but for some people it's not going to work out. This is where I hate binary results. I hate thinking in binary, where like there's someone that's 48, let's say they have 50,000 saved up, which 50,000 is a lot of money, but it's behind at 48 for retirement. And you got this binary thought of, oh my gosh, I'm either going to be destitute on the streets or I'm going to be a multimillionaire sipping champagne. Like, that's what we've all set up this retirement to be like. There are a whole bunch of areas in the middle, to where if you're behind, instead of going all or nothing, why don't you just recognize that, hey, you're going to have to work part-time for 10 of your years of retirement. Or you're going to have to pick up another job now. There's other ways to fix it than going after let's go big or go home on the rate of return. So I don't like binary thinking and things like that. Just understand that that's a risk you're going to take. You can fix this problem with other ways other than just putting it all on black and crossing your fingers. That's a really dumb thing to do with your future.
And let me give you two alternatives while we're talking about it. One, I think there is an enormous opportunity with everybody working from home now, and that momentum probably, that pendulum not swinging the other way probably too much as we go forward. It's probably going to a little bit, but it's just going to be the new way things are. And with what I just talked about before, how the amount of people who can actually retire at a certain age is going to go down, they're still going to need to work. I think there's going to be a huge industry out there for people of retirement age to work online, especially because Gen X and below, we know how to work online. There's no learning curve, really. You can just plug us in and let us go. So I think there's going to be opportunities there, even if it means, like you said, working part-time. There's going to be opportunities to make money for people of retirement age that don't involve physical labor or sitting at a desk all day or something like that. Two, and I've said this many, many times on my own channel, trading is a lifetime skill. If you know what you're doing and you're earning consistent money year over year, that's not going to change when you're 65. And as long as you're cognizant and you know what you're doing, and with something like this, you've probably built up the muscle memory, you can do it in your sleep, you can continue trading well up until the point to where your brain just doesn't allow you to trade anymore, whenever that day is going to be. So your opportunities to make money in many ways, whether it's from actually working, but an easier job, to trading, to taking those profits and putting it into something that pays you, are probably more than you realize. So don't feel that stress of having to have X amount of money by a certain time in your life. I think that fear is very nonsensical for most people, especially if you know how to trade.
And I think you put that perfectly. Trading is a lifelong profession. And even if like right now, so let's say you are, 30 and you've been into this trading game for 4 or 5 years. Guess what? It takes people a decade or 2 decades to reach real proficiency in their profession. You might be looking at what you're making today and being like, ugh, I'm only break even, or I'm still losing a little bit. Look, life is long. So if you were that 48-year-old person that only has 50 grand and you say, oh, what am I going to do? Do you know how good of a trader you're going to be in 12 years when you turn 60? Then you can actually take that money that you have and actually create a decent return off of it, which might fix the math. So the thing I just hate, especially in this episode, is that somebody is going to make a mistake early on in their career and have to quit because of it, because of position sizing, and they never get to the point where they have this lifelong skill. If you get into trading with the thought that, hey, I'm just building a lifelong skill, the money will come when it comes. That's the right way to do it.
So on that note, everybody, don't feel unnecessary stress to hit certain points in your trading career. If you just put your head down and do things right and constantly improve, it's going to get better, and you have a very long time to do that. So for Rob and myself, thank you for joining us here at the Trading Psychology Podcast. We will both see you next time.